Hello and welcome to AE Accounting Tutorials. We are beginning a new series on the double entry principles. This double entry principles is one of the key topics in financial accounting. So understanding this topic helps you build a strong foundation in financial accounting. So if you haven't subscribed to this channel, I will encourage you to subscribe to this channel so that any moment I upload any new video, you get notified on your devices. So this double entry principles, it is a principle that guides us on how to record financial transactions in the book of accounts. So each and everyone practicing an accounting, it is this rule that guides that person on how to record financial transactions in the book. Is that okay? So this double entry principles, it is a principle that is developed by an Italian mathematician called Luca Pacioli in the year 1494. So it is Luca Pacioli that developed this principle in the year 1494. And this principle guides us on how to record financial transactions. Is that okay? So the general rule for this double entry principle is that for every debit entry, there should be a corresponding credit entry. On the other hand, for every credit entry, there should be a corresponding debit entry. So that is the general rule for the double entry principles. Before you'll be able to understand this rule very well, that is, for every debit entry, there should be a corresponding credit entry. And for every credit entry, there should be a corresponding debit entry. Before we understand this, there are certain key terms we have to understand first. Is that okay? So I talk of credit entry, debit entry. We need to understand. First of all, we need to know the class of accounts, because this rule guides us on how to record financial transactions in the book of accounts. So if you don't know your class of accounts, how will you know that I have to record this in this account and I have to record this in that account? So the first key term we have to look at is what is an account. Is that okay? So what is an account? So let me use this book to set an example for you, okay? So the whole of this book could be a ledger, okay? So a page of this is an account, okay? So the accounts are found in a ledger. So in this whole book, one page could be an account, so that we head it and write the name of the account on top and divide it into two. So this is what I mean. So if we have this as one of the page of a book or one of a page of a ledger, we divide it into two so that this will be an account. Is that okay? Basically, that is an account. So account normally takes what you call T forms, okay? So it normally takes what we call T form in this way. Then we divide it into two. The top of the account is what we call the title of the account. So title. This is the name of the account. So if it is sales account, we write sales account over here. But take note that the left hand side of this account is what we call the debit side. The right hand side of this account is what we call credit side. Very good. So if entry or a transaction is being recorded at the left hand side or the debit side, we call it a debit entry. So we've established that this side is the left hand side. The left hand side of the account, this side, we've divided it into two. So this side is the left, this side is the right hand side. And we are saying that the left hand side is called the debit side and the right hand side is called the credit side. So if a transaction is recorded at the left hand side of the account, we call it debit entry. So if a transaction is recorded at the right hand side of the account, we call it credit entry. So we are saying that this rule says that for every debit entry, there should be a corresponding credit entry. But take note, not in the same account. This principle also tells us that every transaction affects at least two different accounts. So it means that in a single transaction, we could have more than two accounts, but we should have at least two different accounts. So if we have account A over here, we have what we call account B over here. The general rule over here is that for every debit entry, okay, there should be a corresponding credit entry somewhere. And for every credit entry in another account, there should be a corresponding debit entry in another account. That is the general rule. Is that okay? So before we proceed to go into details of this double entry, let's look at the classification of an account so that we know which account should be debited, which account should be credited. Is that okay? It is very prudent to know the classification of an account because for each class of an account, there is a double entry rule that guides it. Is that okay? So let's look at the classification of an account. So I'll say account. So we have two broad classification of an account. So the two broad classification of an account is what we call personal account, and we have the impersonal account. Good. Personal accounts are accounts that record transactions relating to persons, as the name applies. So any transaction relating to a person is recorded in the personal account. Okay, so either a person or an organization. So if a transaction relates to either a person or an organization, it will be recorded in the personal account. So on the other hand, impersonal account is also an account that records transactions that do not relate to persons or organizations. Is that okay? I think this is very clear. So these are the two broad classification of an account. We can still come down to classify the impersonal account into two, where we will have real account and then we will have what we call nominal account. So these are the two broad classification. The personal account can be also classified into two. So we will have what we call debtors account we have what we call creditors account. Very good. So let's try to know the meaning of this various class of accounts. So when we talk of debtors accounts, debtors are people or individual that owns a business. Is that okay? So individual that owns a business transactions will be recorded in the debtors account. For instance, when a business makes a sale of an item to a customer for which the customer have not made a full payment, the customer's name will be recorded in that of debtors account. The customer becomes a debtor to the business, so such transaction will be recorded in the debtors account. So with the creditors account, it records transactions of persons or organizations that the business also owns. For instance, when business made a purchases from their suppliers and the business wasn't able to make full payment to their suppliers become creditors. So the business will record that transactions in what you call creditors account. We also have what you call real account under impersonal account. Real account, it is an account that is used to record tangible items. For instance, an asset. Okay, so if a transaction relating to an asset, for instance, motor vehicle, land and building, furniture and fittings, it will be recorded in real account. We have what we call nominal account. Nominal account records transactions relating to expenses, revenue, gains, and losses. Is that okay? Now, beside the general rule guiding this principle, or beside the general rule that tells us how to record transactions in the book of accounts, we have to know the rule or the golden rule for recording transactions in a personal account, in real accounts, in nominal accounts. Probably we can add a rule that guides us on how to record transactions in a cash book. So let's look at the general rule. So let's look at the general rule for both debits and credit. Okay, we've classified the account already, so we have to look at the golden rule in recording in this class of accounts. So we looked at what we call personal accounts, right? Personal accounts. The rule for personal accounts is that we debit the receiver and credit the giver. Is that okay? So if two persons are in the same transaction, the person giving out an item will be credited. His account or her account will be credited. The individual person who received the item, his or her account will be debited. So that is the general rule for personal accounts. I said personal account has to do with debtors account and creditors account. So if a debtor is receiving, we debit debtors account. If a creditor is giving out, we credit creditors account. That is the rule. Let's look at that of real accounts. Real accounts. So the general rule for real accounts is that we debit what comes in and credit what goes out. Example of real account we said is an asset account. So example of an asset account could be motor vehicle. So if we acquire a motor vehicle, the motor vehicle is coming in. Okay, so we debit the motor vehicle account. So with the business, we are also losing cash. Cash is going out. So we credit cash account and debit motor vehicle account. So we debit what comes in and credit what goes out. That is the golden rule for recording real accounts. So debit what comes in and credit what goes out. Very good. Let's look at that of nominal accounts. The rule for nominal account is that we debit all expenses and losses, then we credit all gains and revenue. So we debit all expenses and losses, and credit all revenues and gains. All right. So the general rule is that we debit all expenses and losses and credit all revenues and gains. This is the reason when we incurred an expenses or we paid for rent, that is an expense. So when we paid for rent, our cash is going out. We use cash to pay. So from real account, we credit what goes out. So it means we will have our cash account, then we will have the expenses account, which is rent. So the rule is saying that we debit all expenses and credit all revenue. Is that okay? With this rule, cash is going out. With real account, cash is going out, so we credit cash. With nominal account, we debit all expenses, so we debit all expenses. Do you get it? That is it. So we can also consider the golden rule for cash book. Is that okay? But cash book is not part of the class of accounts, but I just want to add this. So for cash book or bank account or bank account, the general rule is that debit all receipts and credit all payments. So we debit all receipts, then we credit all payments. Very good. So when we are recording transaction in the cash book, anytime we receive cash, we debit the cash book. Anytime we pay out cash, okay, we credit our cash book. For instance, when we use cash to pay an expense, we credit the cash book in the name of the expense account, then we come to debit the expense, because from nominal account we debit all expenses. So if you really understand this, if you want to take a question on double entry, it will be very simple for you. So we can proceed on to look at the double entry for assets, liabilities, capital, revenue, and expenses. But we can even deduce that from here. So let's quickly look at that as well. So I want us to look at the golden rule for some basic terms that we will be seeing when we are recording our financial transactions. So the first item has to do with assets. So anytime we acquired an asset, it means our asset will increase, okay? And anytime we sold our asset, it means our asset will decrease. So anytime an asset increases, we debit the asset account. Anytime an asset decreases, we credit asset account. Okay, so we know the examples of assets. We could have land and building, we could have furniture and fittings, we could have office equipment. Is that okay? So well, we can also talk about what we call liabilities. So anytime liability increases, we credit it. We credit liability account. That is when liability has to do with financial obligations that business has to pay to outsiders. So if a business go in for loan, its liability will increase. So we credit liability account. Anytime liability decreases, we debit. That is the rule. Okay. The third one, I could talk about capital. Capital has to do with the amount of money or resources that the business owner has introduced into the business. So anytime a business owner introduces a capital or an increase in capital, is what we call credit. We credit it account. Anytime a capital decreases, we debit. A capital can decrease when the owner of the business makes drawings for personal use. So in that circumstances, we debit capital account. But anytime the business owner introduces capital, we credit capital account. Is this clear? Well, we can also look at other items that are also necessary. We can talk about sales. Anytime business makes sales, okay? When we make sales, we credit sales account. We credit sales account. And then we debit cash account or debtors account. Take note, we have what you call cash sales and credit sales. So when we sell products or stock to our customers and the customers has made payment immediately, we call that cash sales. So the transaction will be we credit sales account and then we debit cash account or bank account when the money is being received through check. But when we make sales to our customers and our customers wasn't able to make the payment, then the transaction will be sales account and debtors account. So we credit sales account and debit debtors account. That is when the customer wasn't able to make payment. Is this clear? Well, sometimes we may make sales to our customers, and our customers, because of certain reasons, the product may be faulty. They will decide to return part of the product to the business. So when business makes sales to their customers and some of the customers return the goods to the business, we call that a return invoice. So the fifth item is return invoice. Another name for return invoice is sales return. So when customers return goods to the business, the transaction is that we credit debtors account or customers account, then we debit return invoice account. That is the general rule. We could also talk about what we call purchases. That is where business go to their suppliers to make purchases or buy an item. Okay, businesses go to their suppliers to purchase an item for resale. So when they purchases, okay, the transaction has to go with we debit our purchases account and credit cash account. That is where the business has made purchases with cash. So we debit purchases account, then we credit cash, because when we made purchases, our cash will be going out. So we credit cash account or bank account. That is where we made payment by check. Okay, but when we make purchases from our when we make purchases from our suppliers and we are not able to make the payments, our suppliers becomes our creditors. So the transaction will be purchases and creditors. So we debit the purchases account and then credit our creditors account. Creditors account. Very good. Let me talk about one key item. We could have what we call return outwards. A return outwards. A return outwards is a situation where a business make purchases from the supplier and the business realize that part of the goods is not good for their use. So they will decide to return part of the goods to the supplier. So when this happens, there will be a transaction between the supplier and the return outwards. Okay, so initially the supplier has what we call a credit balance. Okay, already. So when we are returning, what do? We debit the supplier's account, that is the creditor's account, then we credit return outwards account. So we debit creditor's account, then we credit return outwards. Okay, I said with the return outwards, it has to do with a situation where business return to some of their purchase item to their suppliers or creditors. Okay, so when this happens, we credit the creditor's account and debit return outwards account. But take note, when the purchases has been made with cash, it means there is no creditor anymore. So to pass the double entry for return outwards, we rather debit what we call the cash book and credit return outwards. Is that okay? So after knowing the double entry rule that guides how to record all these transactions in the book of accounts, it will be very prudent for us to take a practice question and see how we could record transactions in the book of accounts. So this will bring us to the end of this video. In a subsequent video, we may take a full practice question and see how we could record transactions in a book of accounts. Afterwards, we proceed on to look at how we prepare a trial balance from the list of balances that we've done in the normal accounts. So if you haven't subscribed to this channel, I will encourage you to subscribe to this channel, turn on your notification bell so that any moment we upload any new video, you'll get notified on your devices. Until we meet, I think it is bye for now.